Index funds and ETFs are the two most popular ways to invest in the stock market today. They're often pitched as alternatives to each other, but they're not. They do mostly the same thing in slightly different ways, with one critical difference that affects your taxes. Here's exactly when to use each. Together, ETFs and index funds hold over $15 trillion of American investor money. They are the foundation of modern retirement investing. And the truth is, they're more similar than different. The differences that matter come down to a handful of things, and one of them can quietly cost you thousands of dollars in taxes you didn't have to pay. Most beginner videos skip this part. Index funds and ETFs have way more in common than they have differences. Both are pooled funds. Your money is combined with thousands of other investors' money to buy a basket of stocks. Both can track the exact same index. The Vanguard S&P 500 Index Fund and the Vanguard S&P 500 ETF own the same 500 companies in the same proportions. Both charge near zero fees today, often less than 0.1% per year, and both let you own hundreds or even thousands of stocks in a single purchase. So if they're so similar, why does the choice matter? Here's how they actually differ. On trading, index funds settle once a day at end-of-day net asset value. ETFs trade like stocks, with prices changing minute by minute. For a long-term investor, this honestly doesn't matter much. On minimum investment, ETFs win. You can buy one share of an ETF for whatever the share price is. Index funds often require an initial minimum, like $1,000 or $3,000. On tax efficiency, this is the big one. ETFs are structurally more tax efficient than index funds because of how they handle redemptions. We'll show the numbers in a moment. On automatic investing, index funds win. You can set up a recurring transfer of exactly $50 or whatever amount you want, and it just works. ETFs require buying whole shares, though some brokers now offer fractional ETF purchases. And on best use case, index funds shine in 401k and IRA accounts. ETFs shine in taxable brokerage accounts. The verdict is simple. Both work. Use the right wrapper for the right account. Here's the big one. In a typical year, most major ETFs distribute zero capital gains. Their investors only pay capital gains tax when they sell the ETF themselves. Index funds, by contrast, distribute capital gains every year, usually 1 to 5% of the fund's value. That's taxed in the year you receive it, even if you didn't sell anything. In a taxable brokerage account, this can quietly cost you thousands of dollars over a decade. In a 401k or IRA, it doesn't matter. Those accounts are tax sheltered, which is exactly why we use different wrappers in different accounts. So when do you reach for an ETF? 4 situations. 1. Taxable brokerage accounts. The tax efficiency advantage is real and compounds over decades. 2. When you want to invest by share count, like buy me 5 shares of an ETF. 3. When you need intraday liquidity, meaning the ability to buy or sell at this exact moment. This is rare for long-term investors and honestly mostly irrelevant. 4. When your broker offers ETFs commission-free, which most major brokers now do. When do you reach for an index fund instead? 4 situations. 1. Your 401k. Most 401k plans only offer index mutual funds, not ETFs. 2. Your IRA or HSA, where you want set-it-and-forget-it automation. 3. Anytime you want recurring exact dollar investments, like invest $200 every month, regardless of what shares cost. 4. When you don't want to think about share counts. Index funds let you put in any dollar amount, and it just works. 3 myths to bust before you go. Myth 1. ETFs are always cheaper than index funds. Used to be true, not anymore. Today, the cheapest index funds and the cheapest ETFs charge nearly identical fees, often near zero. Pick based on the account, not the fee. Myth 2. Index funds are outdated. False. Index funds are still the optimal choice in 401k accounts, IRAs, and HSAs because of the automation and because the tax shelter makes the tax efficiency moot. Myth 3. And this is the biggest. I have to pick one. You don't. The smartest move is to use both. Index funds in your 401k and IRA. ETFs in your taxable brokerage account. right wrapper for each account type. Index funds and ETFs aren't competitors. They're different tools for different jobs. ETFs for your taxable accounts, index funds for your retirement accounts. Use both. Win in both.